Good morning. Welcome to Trading Hour. It's a Monday morning. It's 11 o'clock. We're coming to you live from the CNBC TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Vivek Iyer. And what a powerful start to the week. Straight away off to the races, benchmark indices up 1%. The Nifty is closer to 24,100, and now it's crossed the 200-day moving average, which was 24,050. Technical analysts were looking at it as an important resistance level, and now that we've conquered it, perhaps the bulls will draw some more comfort for upside. Broader markets have participated, in fact, doing even better. The mid-cap index is up nearly 2%. The advanced decline ratio has 2,000 stocks advancing for about 500 stocks declining, and it's good to see both banks and IT. These are the two leadership sectors in terms of weightage. They contribute a lot, more than 50% of the overall index, and both banks and IT are on the way up. Banks, because the numbers from HDFC Bank, ICICI Bank have been fairly robust, particularly ICICI Bank, and IT, just going by the reaction to numbers like in Infosys or Tata Elxsi, where the numbers were muted. But the stock price reaction is telling you that perhaps incrementally there is no bad news, right? Whatever bad news was there was known over the last couple of days in terms of growth slowing down, margins being under pressure, FY26 being a tough year, challenging year. All that was known when TCS and Wipro came out with their numbers. Incrementally, there is no, bad news that we've heard, which should drive the stocks further down. Whatever pain was there is now perhaps in the price.
Good morning, Reema. What a wonderful start as far as Monday is concerned. And like you mentioned, the Nifty IT probably digesting most of the negative news flow like you've mentioned. Well, the other set of stocks doing very well is the banking pack, record highs. All three of the stocks, HDFC, ICICI and Yes Bank, all of them that delivered results over the weekend doing very well in the session. ICICI Bank cooling off a little bit from the day's highest point. A couple of other stocks, from the broad end of the markets that are doing very well. Have a look at the wind turbine listed companies, so the generators like Inox Wind and Suzlon, draft norms coming in, and both of these stocks, both Suzlon as well as Inox Wind, today doing very well in the session. Also, the pharma pack, there have been a few stocks that have outperformed, Divi's Labs being one of them. Incremental positive news flow coming in out there. The company has gone ahead and signed a long-term supply deal with a global pharma company, and Citi actually guesses that this could be a GLP-1 opportunity with Eli Lilly that Divi's has probably gone ahead and signed an agreement with, which is an incremental and material opportunity for Divi's. Well, the other stock on focus, something that our colleague Sudarshan pointed out at 9 a.m. today, that is Gail. And a tariff hike consultation paper is something that is being deliberated. Gail doing very well in the session, and HDFC Life, one of the few stocks that are reacting a little negatively to earnings. H1 is expected to be slightly tough for the company on a high base. No wonder then the stock is lower by 1.5%.
This week, we have SBI Life also reporting numbers amongst many others. So we'll see if SBI Life also has a tough Q4 and a guidance. But let's talk about Just Dial, because that's one of the big movers today. 9% up on Just Dial, and 12% up now. Let me tell you three quick reasons why the stock is up despite a muted Q4. One, collections, which is basically cash collections, is improving. Collections in Q4 was up 11.3%, better than what we've seen in the prior quarters. Secondly, the cash on the books is 60% of its market capitalization at more than 5,000 crore rupees. And three, even as the company's growth is a bit challenging to come by, the company is improving its margins. In FY25, the company's margins went up by 860 basis points. So from 20.8%, EBITDA margins in FY25 were closer to 30%. That's a big improvement. Now, as I said, Q4 is a slow growth, In fact, growth has been slow for Just Dial. In Q4, the top line growth was 7%, lower than what we've seen in the last 2 or 3 quarters. Margins, though, the company's held steady, closer to the 30% mark, and profits aided by higher other income is up 20% on a quarter-on-quarter basis. There is a conference call later today at 6 o'clock, so we will get more clarity. But 3 reasons: collections, the cash, which provides downside support, and the fact that margins of the company are very healthy at 30%.
Deepa, were you surprised by the stock reaction at Tata Elxsi?
Absolutely.
Tough quarter, maybe auto vertical not doing so well. So Tata Elxsi, have you had a chance to look at the internals?
Yes, so Tata Elxsi has completely reversed its morning losses. Stock had opened with a cut of about 2 to 3%, but now it's higher. As I said, the Q4 was disappointing. There is no doubt about it. It was a third quarter of a miss. The top line declined by 5.3% on a quarter-on-quarter basis. EBITDA margins sharply lower at 22.9%. lower quarter-on-quarter and on a year-on-year basis. In fact, in the last 9 quarters, in 8 quarters, margins for the company have actually declined, and profits too are down 13%, both quarter-on-quarter and on a year-on-year basis. So the question is, what could be driving the stock price higher? Now, in the conference call, the company said they expect growth to return in Q1 of FY26. They also said that FY26 growth rate could be better than FY25. Analysts are saying this is challenging. It's going to be difficult for them to achieve that, but the company is saying FY26 ought to be better than FY25, and what's giving them confidence is the large deal wins that they have. In fact, even in Q4, and that was a silver lining in the quarter, the company announced large deal wins, a $100 million deal in media and communications and a €50 million deal in the transportation vertical, and that will help. Also remember, the stock for the last 3 years has done absolutely nothing. It re-rated after COVID when growth rates were 20, 30, 35%. But in the last 3 years, that's 28% down in FY25. But in 3 years, the stock is down 35%. Now, the question is, valuations is still at 30, 32 times. Is it attractive enough because it's fallen from the previous peak levels, or is it still too high? Brokerages that I've looked at so far, and I'm sure there are many who are bullish also, but the ones which I could glance through, Kotak as well as Ambit, both of them have a sell call on the stock.
A cautious view, but the stock today doing quite well. Well, moving on to the oil and gas space, the natural gas regulator, PNGRB, has floated a consultation paper for a review of natural gas pipeline tariffs. Sudarshan joins in to tell us more and also what brokerages are making of the same. Sudarshan, you highlighted this earlier in the day at 9 a.m. Take us through the internals if you've had a chance to look at what exactly this means for Gail.
So the first, if I can say why the stock is positive, because the tariff hike has been long pending, and now after PNGRB coming out with the paper expecting a consultation from stakeholders as well as Gail, it implies that tariff hike can come very soon. In the month of June, PNGRB will have the board meeting and tariff hike can be approved. So what was the Gail's submission? Gail had asked for tariff to be increased to rupees 78 per MMBTU, and after certain queries from PNGRB, it was settled at rupees 77.43. Now, we had a conversation with Gail last month in which Gail did say that it has proposed for tariff to be increased to rupees 78, but even if PNGRB approves up to rupees 70, it would be taken positively. What does CLSA say on that? CLSA has first upgraded the stock to outperform from hold rating. Also, it has increased target price to rupees 210 from rupees 175 per share. Now, CLSA believes that there can be a tariff increase in the range of 20 to 25%, and it has even lifts EPS estimates in the range of 9 to 19%. And it says it's a start of the review process, which raises its confidence that tariff hike will come in the next PNGRB board meeting. So the biggest positive is that tariff hike has been long pending for its pipeline. There are 10 gas pipelines of Gail, and if there is a tariff hike and if it's increased up to rupees 770, it would be taken positively, and that's the reason you are seeing a big move in the stock.
Thank you very much for that. Get into a break. On the other side, we'll get chatting with Devan Jain from Inox GFL Group. He'll talk about the latest deal wins and the FY26 outlook. Welcome back. Let's talk commodities. Manisha is here joining in, and she's focusing on crude prices and gold. Manisha.
Oh, well, yes, one a gainer and another a loser. I'll start with the gainer first. And an all-time highs in case of gold prices, $33.85 an ounce as the last count. We have seen prices gain up by 29% in this year now, and it is up 45% in last 1 year. It's not just the international markets. Gold has made all-time highs in various currencies, starting from Japanese yen to euro and the Indian rupee as well, where when you look at the prices, add a GST and a minimum making charges to that, we are trading at above lakh rupees at 10 grams right now. And the markets are seeing support from the decline in dollar index, which is below 99, a new 3-year lows, and all the kind of statements that have been coming in from US President, whether it is about investigating on critical minerals or about firing the US Fed Chair Powell, or of course talking about higher tariffs going forward if the countries retaliate. All of that has been adding premium to the gold prices, with banks and brokerages telling us that the prices can move much higher from here. The next targets after 33.85 are $3,500, $3,700 an ounce as well. And of course, there are some banks and individuals talking about $4,000 an ounce in this year if the situation continues the way it is or gets even extreme from here. So that's about gold. But what is not doing so well today is the crude oil prices. The decline is coming on the back of US and Iran going back onto the framing table. The understanding is that the nuclear deal framework could be happening in this week itself, and that has taken some premium off the prices. The markets also are looking at higher production from OPEC, from US and non-OPEC countries as well. And the demand on the other side has been cut as in sense of revision for this year, and that has been weighing onto the prices. So 1.5% of decline in the Asian markets right now for crude prices.
Thank you so much, Manisha, for joining in and telling us about what exactly is transpiring as far as crude oil is concerned. But moving on, it's a good time to get in Soni Patnaik from JM Financial Services for a quick technical check of the market. Thank you so much, Soni, for joining us. 24,100 is what Nifty has managed to scale. Bank Nifty at record highs. Where do you see markets headed from here on?
Hi, good morning, Vivek. Rima, thank you so much for having me on your show. I think Nifty still continues to show that strength and anyway towards 24,200 to 24,300. I think that range is going to get tested first before seeing any sort of profit booking. One may continue to hold on to the longs. The put writers are definitely trying to increase or raise their base from 23,500 to 23,800 as of now. So I think that 23,800 support gets defended. Nifty test 24,200 to 24,300. Maybe some profit booking gets to be seen from those levels, but as of now, the uptrend is yet to continue from here. Similarly, if we talk about Bank Nifty also looks quite strong with its all-time highs today, and it may head towards a 55,700 to 56,000 range before seeing any sort of profit booking. Both the indices as of now remains as a buy on declines, and any profit booking that we may see ahead in the next 1 to 2 days may only be a good strategy to initiate longs on those declines.
Okay, and Soni, any individual stocks that you're looking at?
Right. So Vivek, the first buy would be an official recommendation that is in Theta Curd, which is seen above its shorter moving averages crossing today. It is also giving a good option chain breakout above a 805 level. So one can buy Theta Curd at current levels, keeping a stop loss of 785 and a target towards 830 to 850 can be seen. The second official recommendation for us today is in the banking space, which is PNB, looking for quite a strong breakout. The stock is heading towards a target of 107 to 113. So one can accumulate PNB at current levels and on small declines up to 100, keep a stop loss of 95 and targets of 107 to 113 can be seen.
Thank you for joining in. We will slip into a break. As promised, on the other side, we'll get chatting with Devang Jain from Inox GFL Group. Stay tuned.
Welcome back to Trading Hour. Well, an important development as far as wind turbine manufacturers is concerned. The Ministry of New and Renewable Energy released a draft notification mandating local sourcing of key components like blades, gearboxes, generator towers. To discuss this in detail, we are now joined by Devang Jain, who's the Executive Director at Inox GFL Group. Thank you so much, Devang, for joining us today. First up, have you had a chance to look at the draft notifications that have been put up by the MNRE? What are the earlier notifications? What are the current notifications? And how does it benefit Indian domestic manufacturers?
Hi, good morning, Vivek. Pleasure to be back on CNBC. No, certainly. So, I mean, we've been working with the Government of India and MNRE and the related agencies on getting a regulation to the extent which has come out in the public domain now for the past 2.5 years. As many of you may be aware, there is something called ALMM and ALCM, which is now coming forth for the solar industry, which basically mandates domestic manufacturing. And I think what has been happening in the wind sector in the the post-COVID era, you've suddenly seen a couple of Chinese guys come into India with I would say C-grade products. You have more expected to come in, given that we never had any domestic content requirement notifications in place. And I think what this does is a big positive for the domestic industry, where the current policy was that you simply need to have something called RLMM, where turbine manufacturer needs to enlist his model and his plant with the government of India. Under the new regulation, you now need to domestically procure blades, towers, generators, and gearboxes. Now, if you put these four things together, that would constitute almost 75% of the turbine cost, barring the EPC, which anyways is a domestic play. So this is a huge positive for the domestic wind industry. And clearly, Inox Wind is going to be a huge beneficiary of this.
Of the four items now, are you importing any? What percentage of your components is imported right now?
So basically, all our blades and towers are domestically manufactured by us. With respect to the generators and gearboxes, partly we have imports. But we have a large enough domestic supply chain, which is already available for us to leverage upon. So currently, if I may not be mistaken, broadly, I think 70 to 75% of the entire turbine cost is domestically made by Inox Wind. So we are well positioned to meet these norms.
Devans, we want to understand what exactly is happening on ground. Number one, out of the total projects that are currently being executed, what is the proportion that, the Chinese players are enjoying? We understand that Envision has almost a 10 gigawatt order book currently. So now, in the current execution cycle, will they be forced to go ahead and meet these norms that are likely to come into effect soon? Or will this only be for incremental bidding? And incremental bidding, what will be the win percentage that you will enjoy?
No, so first and foremost, with respect to the regulation, as soon as the draft becomes law, it goes into operation. So whether they give us 6 months or 200 megawatts, there are two criteria. It goes into force as soon as it becomes law within 6 months. And then no matter what the bidding criteria is, everybody needs to follow the rule of the law. With respect to, I won't comment specifically on any specific manufacturer, but having said that, I think a lot of people make a lot of announcements, noise, and I keep reading about, historically at least, a lot of order wins by one or two of these Chinese guys. But if you look at what's been executed on the ground, is virtually 1,000 megawatts. So in some cases, it's 10 to 15% of the so-called order book over the past 2-3 years. I wouldn't read much into it. I think the two key domestic players, which is us and Suzlon, I think, frankly speaking, I think the two of us are the ones fundamentally executing maximum number of projects on the ground. We possibly are the largest turnkey solutions provider in the country at this point in time. And I think with respect to ongoing bids or bids which will come in as we move forward, I think it's going to be increasingly more and more difficult for some of our Chinese colleagues to take in orders, given the fact that you had a lot of C-grade component dumping happening in India. And now with this notification and law going into force, that entire so-called cost arbitrage is completely gone.
But just for you, are there any cost implications? You said part of the gearboxes and generators are imported by you. And about, I think, 25 to 30% is imported of the overall turbine because the balance is made domestically. So now, as you look to replace that, will there be any cost increases? And how would you assess the overall financial impact of this development?
Again, I think that's absolutely insignificant for us. As I mentioned, a big chunk of our procurement, 70-75% of the entire turbine cost, is anyways domestically manufactured. With respect to some of the components which we are partly importing, we already have a large enough domestic supply chain in place. We'll simply shift the entire volume to these guys. Given the fact that there is been 2 years that this policy has been in the work, and again, the policy is not abrupt where it goes into force tomorrow. So there is a period of 6 to 8 months. So I think that's more than comfortable for us. Again, with respect to the remaining 20-25%, look, it's not just China. You've got some components, for example, balsa, which is used in bids coming from Ecuador. Everybody, gets it from Ecuador because that's 90% of the global market. Various other components come from different parts of the world. So it's not as if everything is only coming in from China. Certain components, the quality is better, they're far more competitive. So, again, I think for us to possibly be 80-85% local is not rocket science, but I think we've got a mix and match in our supply chain. We've de-risked countries in our supply chain. So everything is also not just focused on India. God forbid something was to go wrong with a vendor in India. We had various vendors globally as well. So for us, our supply chain is very, very integral to our success. And that's also the reason why we enjoy one of the highest EBITDA margins in the industry.
Right. Devansh, couple of quick points. On-ground execution, are you still facing land delays, something that players have highlighted in the last couple of quarters? Number two, can Chinese players actually find a way around this particular notification? Could they go ahead and form JVs with existing Indian players?
Look, let me answer the second point first and then come to the first point. Now, whether it's JVs or minority, majority, it's absolutely, frankly, irrelevant because the product has to be domestically manufactured. Now, you may get into a JV with a large corporate or whatever it may be, makes no difference because effectively, whoever you are, the blade, the tower, the generator, and the gearbox has to be domestically manufactured. Full stop. So it really doesn't matter whether you're on your own or whether you do a JV or a minority or whatever with somebody else. Coming to your second question with respect to execution on the ground, I think, what's very important, which people, Vivek, I would like to talk about is the fact that, these are long gestation projects. Wind infrastructure is not something which any Tom, Dick and Harry can do or, we are in solar as well, but solar is probably 1/10 the complexity of wind. Having said that, you need to plan a couple of years in advance, and then you need to get your connectivity and land in place. At Inox, we control over 5 gigawatts of plug-and-play common infrastructure across the country. And I think that's a huge moat for us, which is what we continue to leverage and build upon as we move forward. With respect to a lot of other players in the market, they suddenly win a tender and then they come and say, oh, our connectivity is delayed. Oh, the land is not in place. My friend, it's not going to get in place in 1 or 2 quarters. This requires years of planning. And other than that, I would say, the routine land-related issues or routine delays sometimes in evacuation infrastructure is part and parcel of the business. Nothing which requires a special mention. I think the government has done a phenomenal job over the past 2 years in easing out a lot of the operational difficulties. In fact, even this domestic content requirement notification which has come out is a huge step forward to ensure a resilient domestic supply chain.
Vance, I know you're in the silent period. You may not be able to talk numbers. Today, you've given an update to the exchanges on the 1,500 megawatt framework agreement that you have with a subsidiary of CESC. What is the development on that front? How much of it is in operation? And that particular project, what can be the incremental EBITDA contribution once it comes on stream?
Look, I'll simply talk about what's in the public domain, given we are in the silent period in real estate, right? So we've taken out an update where we signed an agreement of about 1,500 megawatts with CESC's subsidiary, Purva Green. We currently have received advances for the roughly 1,000 megawatts of turnkey development across 3 different states. All these projects are now have gone into execution. And yes, there's a period over which commissioning starts, kickstarting from this financial year. This was, if you recall, an agreement where we were to build out 1,500 megawatts for them in the next 3 to 4 years. Happy to say that the turnkey should happen prior to that period. With respect to the remaining 500, it's expected to move forward in the near future. And of course, we'll keep the markets updated as we move forward on that. No specific comment on EBITDA, but as you know, we've upgraded EBITDA a couple of times over the past 3 quarters. We currently, I think, have guided for about 18% EBITDA margins, if I'm not mistaken. We have historically been doing better than that. So I wouldn't be able to, lay more emphasis or talk more about that at this point in time.
Devansh, always a pleasure chatting with you. Thank you very much for joining in. Let's get on to the big story then. US Vice President J.D. Vance has arrived in India. Parikshit is now joining in to tell us more on what's on the agenda. Parikshit.
Well, J.D. Vance has arrived in India for his first official visit. We got those pictures of him getting down from the aircraft with his wife, Usha Vance. Their 3 children were dressed in Indian attire. They are at Akshardham Temple right now. They have strong Indian roots. Usha Vance is of Indian origin. She has family here, friends here. So this is an important official plus personal visit for them. They will be staying at the famous ITC Moria in New Delhi. And ITC Moria is a place where many US presidents and their families have stayed when they visit New Delhi. In the evening, JD Vance will be calling on Prime Minister Narendra Modi at his residence for an official meeting. That will be a 30 to 40-minute meeting, and we believe that trade could figure prominently on the agenda. We hear from sources that the Indian government is willing to give concessions as low as 10% all across the board as the average tariff to the United States, but US wants a zero tariff regime. So somewhere India and the US will have to come to a compromise as far as the tariffs are concerned. While the PM and JD Vance are likely not to go into nitty-gritties of the tariff negotiations, they may show an intent to resolve all the outstanding issues as soon as possible. Issues related to security, to defense acquisitions, energy are going to come up for discussions. Manufacturing, startups, space cooperation will be very important. Discussions on the Russia-Ukraine war, on the Middle East, in Gaza, will be important in those discussions. And both India and US may share their view on the economic and security challenges arising from China as well, considering both countries have high trade deficits with China, and they are concerned about China's role in the Indo-Pacific as well. From here on, JD Vance and family will leave for Jaipur, where they'll visit the Amer Fort. They will have an address at the Rajasthan International Center, and finally they go to Agra, and following which they leave for the United States.
Thank you so much, Parikshit, for joining us and giving us an update on this very important.
This is the first time that a US Vice President is visiting in the last 12 years.
Wow.
So while there is cultural and personal significance to this trip, it's always going to be a diplomatic mission as well. So all eyes will be on this one.
Let's wait for the outcome, whether there are any material developments from this particular visit. We'll take a quick break. Post the break, we'll put the spotlight on HDFC Bank and ICICI Bank on the other side.
Welcome back. Tata Elxsi is climbing higher and higher, and another stock which deserves mention is BHEL. Came out with a muted set of numbers, BHEL, but the stock is now inching up. It's moved back into the green after opening up. It was a bit of a, I think, subdued set of numbers for BHEL, but the stock is seeing some recovery. So it's that kind of
top line muted. So execution FY25 along expected lines has been muted. There's been quite a lot of worries in terms of execution, but the order book, something given the fact that it's almost the sole player when it comes to thermal power EPC in India. Order book has been very strong, and that is something that has led to a bit of a recovery.
I think 92,500 crore of order inflows in FY25. So that's a fairly sizable number. But let's now go across to Abhishek. He's going to tell us how ICICI Bank fared in the fourth quarter. It's a bank which has been delivering stellar numbers in the face of heightened competition, irrespective of the macro challenges and the asset quality issues that peers have had. ICICI Bank's numbers quarter after quarter have been very resilient and strong. Abhishek is now here with more.
With respect to ICICI Bank, the loan growth momentum is weak. However, the P&L is very strong for them. Versus our poll, the NI and PAT is a beat on our poll. Deposit growth came in at 14% YOY and about 6% sequentially. YOY, it's one of the weakest growth that you are seeing in last 8 quarters. Now, advances growth were on the lower side at just 13.3% YOY and 2.1% quarter on quarter. So YOY, it's the weakest growth that you are seeing in last 17 quarters, and sequentially, that is quarter on quarter, you are seeing one of the weakest growth that is coming in 15 quarters. Net interest margin is at 5-quarter high of 4.41%. Core operating profit growth is at 5-quarter high of 13.7%. Now, quarterly annualized slippage ratio is at 17-quarter low of 1.5% versus 1.85% in the previous quarter. Their asset quality continues to show robust decline and is one of the best in last 10 years or even more for them. Gross NPA ratio and net NPA ratio have improved, with ROA or return on asset being the highest ever that they have recorded, north of 2.5% in this quarter. Back to you.
Thank you so much, Abhishek, for joining in and taking us through the internals of ICICI Bank as far as the results were concerned. But remember, the management also held a post-earnings conference call over the weekend. Let's listen in to key excerpts from that call.
So as far as the loan growth is concerned, I don't think anything specific incrementally in terms of caution on the credit side. I think we are pretty comfortable with what we are underwriting. Of course, on personal loans and cards, as you know, we had tightened, a few quarters ago, and that is showing up in the volumes over the last couple of quarters and the loan growth. But other than that, no specific caution on the credit side. I would say it's largely a function of what is happening in the system. And also, I guess, on the pricing side, some consciousness given that, during this quarter, we were at the sort of cusp of the, downward movement in benchmark rates. We have seen liquidity improve substantially over the last couple of months with all the measures that the central bank has taken. And deposit growth for us has continued to be quite strong. You would have seen the numbers for the fourth quarter have also been pretty strong for us. So, and as the rate, now, of course, if you look at it, the repo rate has fallen by 50 bips. So that will start to see a transmission into deposit rates, which is what has started. So I think that's, in the natural course of things.
Okay, the other big one is HDFC Bank, and that too is sitting at a record high today, post the numbers. The stock is up nearly 1.5%. And HDFC Bank and ICICI Bank have done well last week as the FI buying has returned to the market. We know the FIs have a preference and a bias towards these private sector financials. Now, HDFC Bank's numbers were also strong. In the conference call, CEO Shashidhar Jagdishan commented on how the bank will place itself amongst the will position itself given the global macro uncertainty and plans with its key ratios in the coming fiscal year.
We've already seen 2 rate cuts, and the change in stance from neutral to accommodative is a welcome relief to all of us. RBI intends to increase durable liquidity, which is followed by concrete actions, which along with rate cuts will help supporting the GDP growth. For FY26, we expect the GDP to be supported by a pickup in rural spending, discretionary consumer demand, and investment activity. Of course, the goods exports may be impacted until the global trade and tariff situation becomes far more clearer. We acknowledge that the global macroeconomic outlook has become more uncertain due to the recent trade tariff-related measures and the volatility surrounding them. This may potentially impact global inflation, leading to lower growth across economies. Corporates have adopted a wait-and-watch stance, and we are waiting for more clarity. We remain watchful. Our credit deposit ratio has been brought down from the highs at the time of merger, which was at about 110%, to around 96% as of March 2025. Our deposits have grown faster than the system, and so has it grown faster than our loans as well. Next year, in line with what we had committed, the adjustment in CD ratio will not be so steep, supporting the loan growth for the bank, but it will be on a downward path. Asset quality, one of our USPs, remains pristine. As liquidity and growth improve, we are well placed to grow in both assets and deposits.
Well, that was the CEO of HDFC Bank in the post-results conference call. But moving on, in the latest episode of Market Cafe, Surabhi Upadhyay caught up with White Oak Capital founder Prashant Khemka to discuss what the post-COVID investing landscape looks like. Khemka says investors do need to temper their return expectations as the easy money era of the stock market is probably over. Let's listen in.
Post-COVID 5-year fantasy run is over. Yeah. A dream run, I would call, is much longer term. I would say the last 40 years have been a dream run.
So the fantasy run is over.
The fantasy, last 5 years were pure fantasy.
The market doubled. I mean, from the March 2020 bottom to, I was looking at the charts again, September, the market had just doubled.
Absolutely. See, from 2020 bottom, March 23rd, 2020, the market still, over the last 5 years, small caps, if I'm not mistaken, have quintupled. gone up fivefold if I'm not mistaken. The larger caps included, I think like BSE 500 has given compounded 20% return or something. Some pockets within small caps and mid caps, certain segments which did build some excess. And the last 6 to 12 months, that froth has been to a great extent fizzled out.
It's fizzled out. But, you know, again, I ask this in a very broad way. And I ask this from the point of view of investors who had more time during COVID and decided to come in, and they were either buying stocks directly or, you know, buying in and out of mutual funds. And making money from the market seemed really easy. Is that time over?
Yeah, I think that time is going forward. It's not going to be so easy. So just on that one, you know, retail investors during such time handily beat fund managers, by the way. Yeah. And they feel that fund managers are useless because all the fund managers.
20% मेरे stock पे मिल रहा है.
My son, who's 13 years old, he's managing his younger brother's money already, outperforming over the last just 9 months by 25 percentage points.
Your elder son is managing your younger son's money.
And elder sister's money.
Okay.
And outperforming by 25%.
He's outperforming you also.
Our team is hardly, I mean, our team, compared to him, our team might be outperforming by 3 to 4 percentage points over this time period. So
and how old is he?
He is now going to turn 14. He's 13 and a half or so.
Imagine
So
that.
to him, his God's gift to mankind. Outperforming by such huge. Now, he'll obviously over time come to learn that markets aren't so favorable to small caps because that's the area where he would typically, retail investors in general tend to invest in smaller caps, which have done phenomenally well. So that, I think, should at least normalize.
Most mutual fund managers will tell you that compounding over long periods of time, if you're getting 12% to 13, 14% kind of returns from equities, you're well off.
Absolutely.
But then we got greedy. We've gotten used to, at least 20%, 25%. If you're in a great mid-cap or a small-cap fund or individual stocks, then, sky's the limit. So what is the new reset that we have to go back to?
So if you see over the last 40 years, markets delivered close to around 14% return, but it includes the 80s and 90s where inflation was higher. Over the last 30 years, 20 years, it's been around 12% return. Going forward, assuming an inflation regime which is more in the 4 to 5% range rather than 5 to 7% range, I think a 10 to 11% return from equity markets over the next 5, 10, 15 years is a reasonable base case expectation.
10 to 11%. When people hear you say that, half of them will be pulling their hair out saying,
Pre-tax.
Prashant, what is Prashant saying?
Pre-tax. Nowadays, we have to, unlike in the past,
exactly,
now we have to pay
12.5% tax. Assuming it remains 12.5%.
Post-tax, if you earn 10% going forward, it will be a very good outcome. In an inflation environment of 4 to 5%, 10% is very good, meaning you can double your money in 7 years.
Now that we've understood that this is a real reasonable expectation to have, I want to come to now how to go about investing in this environment. And before that, let's understand earnings. IT and FMCG are two large parts of our large cap universe. And they seem to be stuck in a rut, a low growth rut. Isn't that an overall problem for Indian equities?
See, it remains to be seen how much of it is truly structural and how much could it be on top of. There is some structural element to it, but on top, what is the cyclical element? For many years, we had double-digit growth in consumption. Consumer discretionary was, growing at mid-teens for many years during the 14 to 18 time period for several years. So I think when it settles down, I do think consumption overall can still grow high single digits.
So overall, staples, you're expecting the earnings to recover to what level?
Let's say top line growth of 7 to 10, somewhere in the 7 to 10% range, call it 8 to 9.
And by when? This year?
Oh, very hard to say. This is more like trend line.
And then IT services?
IT services, you're right. I think longer term, over the last 5 to 10 years, it has shown a tendency to be around 5% dollar terms, which is about 8% rupee terms.
Yeah.
So lower end of the staples range, I would say. But 8% is not that bad. You have to obviously marry all this with valuations.
Welcome back. You should just keep your eye out on Hyundai Motor because today the 6-month lock-in of its IPO, shareholder lock-in, will come to an end and a fairly large amount of shares will get released. So according to Nuvama, nearly 50 crore shares of the company, which is worth about $9.5 billion, will become eligible to trade. The 6-month and beyond lock-in will come to an end today, and that's about 60% of the company's outstanding. So that's Hyundai Motor, which you should keep on your radar. But let's welcome Nitin Raheja on the show now. He joins us from Julius Baer, India. Thank you very much for joining in. Nitin, your call for a while has been, bullish on financials. You've been positive, particularly on private sector financials, and now they're the first to get to their record high levels. Where from here? Do you think we've already seen a bulk of the gains, or do you think they are in a structural uptrend, and even at these levels, one can go long and accumulate banks?
So, thank you for having me on the show. But just to, when we talk about financials, I'll just sort of enumerate why we like this sector so much. It's very simple. The sector has been going through a lot of regulatory overhang on the part of RBI. Then you had this whole not structural, I would say, a whole tightening of liquidity in the economy, which came and sort of, hit these companies pretty well. And we've seen deposit growth being tepid. Now, what we are seeing is there is ample liquidity in the economy. We've seen that the regulatory overhang is lessening. And in fact, all the curbs that were coming on unsecured loans, personal loans, we've seen that the net impact, at least when we've seen the two big banks declare their results, we haven't seen a worsening of credit quality. And because of that, we've also seen the RBI roll back some of those measures. So I think with all of that in place, you have these banks sitting very well placed. They've been able to even pass on the cut of repo rates by lowering the deposit rates. We saw that from 1st April onwards. So, and that coupled with the fact that the valuations that these companies in this sector trade at are at probably their lows over the last 10 years. So we've just, in my own view, if there is one place where you can find valuation comfort, at the same time, the upside of growth, that is financials. Now, we are seeing that discretionary consumption is struggling, and the government put in measures as far as in the budget in terms of, increasing the tax threshold, plus a good monsoon and rural. I think you should see consumption come back in the second half. CapEx spending should also start seeing an uptick as we go ahead. So I think they're very well placed for growth as far as the balance sheet is concerned, as far as the regulatory framework is concerned. And hence we think that, that space has yet, long legs or a long way to go.
Nitin, take your point completely on board. Banks clearly cheering, especially as far as the last couple of weeks are concerned. You did mention about significant avenues for growth going forward, but in the quarter gone by, especially for a bank like ICICI Bank, were you a little worried about the loan growth, around 13%, slightly lower than what the street was anticipating? And also your view on NBFCs. Do you feel that they would benefit quicker as far as rate cuts are concerned?
Well, to take your second part of the question first, clearly, I think the NBFCs should be the first beneficiaries of rate cuts because they ultimately, they borrow a huge chunk of the borrowing comes from the banks. So I think the NBFC pack should do well. But however, within the NBFC pack, you have to sort of be very, very selective because what we have seen is in each segment, there are a few NBFCs which have excellent underwriting norms. When we look at NBFCs more than growth, the first thing that I look at is how strong is their underwriting norms and culture. I think that is what clearly, because when you have sources of fund which are higher than banks, and you are actually borrowing from the banks as one of the large source of fund, the spreads that you typically enjoy are leveraged by the fact that you take 5 or 6x leverage and your credit cost being low. So if any NBFC has high credit costs, it invariably lands into trouble. And that's why you've seen since 2018 till now, very few NBFCs generate sustainable wealth. So I think when you look at the NBFC pack, looking at those which have very strong underwriting norms is very important. And I think I agree with you that they will be the first beneficiaries of this. In terms of credit growth, I think we are coming to a realistic level. The fact that the economy is slowing, and those 17-18% growth numbers are going to come down to 13-14% sort of numbers. In a particular quarter, if a bank does less than expectations, that's fine. Because I think the larger banks will primarily land up doing maybe 1.1 or 1.2 times nominal GDP growth. And if nominal GDP growth is going to average anywhere between 10.5, 11%, so you're probably going to see a 12 to or a 13 to 14% sort of growth number payout as far as credit growth is concerned.
Nitin, with the appropriate disclosure, and you could just say that, could you share some of the top bets that you have in your portfolio that you're recommending?
Well, I'm afraid we are not allowed to talk about stock specific in such forums.
Okay. Any new themes which have emerged?
No, I think I think the big what we are seeing today is across the board, a lot of sectors are seeing a slowdown. At least we're going to see a trend emerge in the first half. But within each of those sectors, you will see stocks do better. So I think I think it's very difficult to call a sectoral theme play out. But if I have to take a little longer term view of the next 1 year, I probably see in the second half consumer coming back. And I think the bottom K, which is, we've seen this K-shaped recovery where premium discretionary has done well. I think the bottom K should start coming back because there are a number of levers that are driving. A, inflation has come down. B, you're going to see, the pay commission wage hikes come into play in the next 1 year. So you should see that happening. And with monsoons being there, I think rural should start doing better. So all of these come together should see in the second half a good festival season, and as far as consumption on the lower K is concerned. So I think that is one other area that we see. But otherwise, we believe that this is going to be a more bottom-up market, even among sectors, whether you take pharmaceuticals, whether you take automobiles, you will see one or two companies doing far, far better. And I think that's the way you'll have to play this market.
Right. Nitin, you've spoken about three export-oriented sectors, auto ancillaries, textiles, as well as EMS plays. Given the kind of uncertainty we have around tariffs, how are you approaching this space now? Would you wait for a better opportunity, or are you constructive on them now?
So clearly, the era that we are living in is an era which is going to be, driven by bilateralism. So we're going to see very soon, in the next couple of months, probably the first of these few bilateral trade agreements fall in place with the US. And when that were to happen, you will clearly see some sectors emerging as winners. So if you look at it from an India perspective, right, I do believe that autos is going to be, and auto hanks is going to be a clear, a lot of auto hanks, in fact, have now set up facilities in Mexico, where the US has a more favorable sort of tax agreement. So you will see a lot of auto hanks doing that. Pharma, I think, is going to be around. We are going to see a new deal that will come through. So I think if you're looking at the next 2-3 months, clearly there is a slowdown you will see as far as exports is concerned. In fact, what you might also see as a reverse, that before any of these tax treaties come in, you could actually see the pipeline getting filled. Okay. So you could more aggressive this thing. So you could actually see a good few quarters. And then once the news come, actually the markets start discounting what the news is, the bilateral trade deal is already this thing. So I don't really see too much of a impact on export-oriented sectors over a long period of time.
What's the best way to play the broadening out of the consumption theme? As you said earlier, it was all about premiumization, and we did see, luxury apartments, for instance, like flying off the shelves. But now you expect that with the monsoon, with just better sentiment, the consumption will now broaden out. Would you play it with the staples, the regular HULs and the Britannias, Nestle's of the world, the Dabbers, or would you also look at some other themes, for instance, shoes? Right, they've also been impacted at the lower end. What's the best way to play this consumption theme at the lower end?
So I would probably play it through like you said, footwear, apparels, even, for example, two-wheelers. I would probably play it, and affordable housing, and within that, look at affordable housing finance companies, which is actually a great proxy play for that.
Thank you so much, Nitin, for joining us, giving us your view on a whole range of sectors and the fact that you continue to like a few export-oriented sectoral themes. Thanks so much for joining us once again. Well, we now slip into a short break. More stock-specific action on the other side. Welcome back to Trading Hour. Well, a very important story is what we are picking up from our sources. Sources revealed to CNBC TV18 that Eversource Capital is in talks with ride-hailing firm Bluesmart for a possible acquisition. Parikshit joins in with more details.
Well, yes, we believe that these talks between Eversource and Bluesmart have been on for the last few months. They've gathered pace and gathered momentum in the last few weeks, ever since the irregularities surfaced in Gensol, and they had an impact on Bluesmart as well, considering that Anmol Jaggi and Puneet Jaggi, the co-founders of Bluesmart, own about 25 to 30% stake together in that company. Now, what's been happening is that there is a discussion to buy a majority stake in Bluesmart for around 800 to 850 crore rupees. This is likely to be finalized over the next 2 weeks or so. A final decision is still awaited, but we believe that talks have gained positive momentum. But one of the conditions for taking over Bluesmart would be that Anmol Jaggi and Puneet Jaggi have to step aside and have to distance themselves from the company, and Anmol Jaggi would have to step down from the board as well. So let's see how things pan out. Eversource did not comment on our story, but if Eversource does buy a majority stake, there will also be a question mark on unpaid salaries, the liabilities of Bluesmart over the last 45 to 60 days, and all the pending bills at the company as well. So let's see what happens now.
Okay, that's a big story that we will be tracking. Parikshit, thank you for that. That brings us to a close on Trading Hour. From the entire team, thank you for watching.